In the first half of 2026, one hedge fund returned 439%. By the end of July, it was being forced to sell almost everything it owned. This is how the best AI trade on the market nearly destroyed the person who made it. The fund is called Situational Awareness. Its founder, Leopold Aschenbrenner, is a former open AI safety researcher who was pushed out of the company in 2024. Months later, he launched a fund on a single conviction: that artificial intelligence was about to reshape the economy and that markets had not priced it in. For a while, he looked like a genius. The fund raised roughly $20 billion in under 2 years, and by mid-year it was up 439% after fees. On paper, the single best-performing trade in the market. But those returns came from a specific recipe: concentrated bets on the physical backbone of AI, chip makers, data center power, crypto miners, amplified with borrowed money. When the bet works, leverage multiplies the win. When it does not, it multiplies the loss. In late July, AI stocks sold off hard. The exact names the fund leaned on fell the fastest, some down more than 30% in a month. And because the positions were leveraged, the losses did not just sting, they forced action. According to reporting from the Financial Times, CNBC and Bloomberg, the fund was forced to unwind its entire public stock portfolio to raise cash, reportedly selling much of it to the rival giant Citadel. The exact size of the loss has not been disclosed, but one asset stayed off the table. The fund still holds a private stake in Anthropic, the AI lab behind Claude, reported to be worth around $5 billion. Anthropic was last valued at $965 billion. A public listing expected later this year could turn that single holding into a lifeline. Here is why this matters beyond one fund. The same trade, concentrated, leveraged bets on AI is everywhere right now. Wall Street banks have been quietly issuing margin calls to funds holding crowded AI positions. Situational awareness may just be the first big name to blink. The lesson is not that the AI boom is fake. It is that being right about technology and surviving the market are two different problems. The sharpest believer in AI was nearly undone, not by being wrong, but by borrowing to be right. And the safest thing he owned was not the trade. It was a quiet stake in the company that makes Claude.